The US national debt is over $35 trillion. If you had $1 trillion in $1 bills, your pile of cash would weigh over 2.2 billion pounds. That's more than 500,000 elephants. And here's another one. If you tried to pay that debt off by spending $1 per second, it would take you over 1,000,000 years. Shocking, right? But the real question is, should we be losing sleep over this massive debt? Or is it just an intimidating number that doesn't really matter? Doubling back to the elephants, let's address the one in the room. Polls show that 57% of Americans are worried about the national debt, but there's a sharp divide on what to do about it. Some say, slash spending now before it's too late, while others argue that too much austerity could lead to recession. And of course, the media isn't helping, scaring people with clickbait headlines like US debt time bomb. So what's the truth? And what should you actually be concerned about? There are three major fears driving the panic. And no, it's not spiders, public speaking, or forgetting your phone at home. These are the big economic nightmares that keep policymakers up at night. 1. Economic collapse. What happens if the US can't pay back its debt? 2. Runaway inflation. More debt means more money printing, and that could mean skyrocketing prices. 3. Impact on future generations. Are we dumping this financial mess on our kids? But are these fears overblown? Is the US actually about to face an economic disaster? Or is this debt just business as usual for the world's largest economy? Let's break it down. So, how did the US end up with $35 trillion in debt? Over the last few decades, the government has been spending like it's Black Friday every day of the year. Whether it's defense, healthcare, or stimulus checks, the US has been swiping the national credit card. But it's not just spending. Tax cuts and economic slowdowns have reduced government revenue at critical times. Let's break it down even further into bite-sized chunks. World War II. After the war, the US piled on debt to rebuild, peaking at over 120% of GDP. Reagan era. In the 1980s, tax cuts, military spending, and economic challenges increased debt. 2008 financial crisis. The government spent billions on stimulus packages to avoid economic collapse. COVID-19 pandemic. From 2020 to 2022, the US borrowed trillions to support struggling businesses and individuals. But wait, this brings us to an important question. How much debt is too much debt? For countries, it's not about the raw numbers. It's about the debt to GDP ratio. Right now, the US debt is around 124% of GDP. Historically, when debt to GDP gets this high, things can get messy, but not always. Nearly $7 trillion of the US debt is the government borrowing from itself. Yep, Uncle Sam is using your Social Security and other federal funds like his personal credit card. It's a weird cycle, but that's how the game is played. And let's clear up a couple of misinformation out there. Because everyone loves to talk about China owning America. But guess what? They hold just $850 billion, a mere 2.5% of the total debt. Meanwhile, Japan is actually leading the pack. So, while foreign nations are in for $7 trillion, no, China won't be buying the White House anytime soon. So, with all this talk about debt, here's one easy way to stay out of it. Hit that subscribe button. It's free, debt-free, and it brings you one step closer to financial savvy. And hey, if you want to level up your finance game, check out our merch. No IOUs required. Just click, grab, and wear your finance buffs gear while we all tackle these big money questions together. Here's where it gets personal. You, yes, you, and your financial institutions hold the biggest chunk of the debt. From your pension funds to that super safe US Treasury bond you bought, Americans are sitting on about $19 trillion of Uncle Sam's IOUs. Who knew you were such a big investor? And don't forget the Fed. They hold $5 trillion of the debt, using it to keep interest rates low and stabilize the economy. Basically, they're playing debt Jenga with the whole financial system. Summarized into percentages, 28% goes to the US government, 29% goes to foreign countries, 32% to US citizens and institutions, and the remaining 11% goes to the feds. Let's tackle the big fear, inflation. More debt means more money printing, right? And that means more inflation? Not exactly. Check this out. After World War II, US debt was at an all-time high, yet we didn't see hyperinflation. Why? Because inflation isn't just about how much money is printed. It's about how much money is chasing goods and services. When production can't keep up, that's when inflation spikes. That's what happened in 2022 after the pandemic. We saw inflation rise to over 8% because supply chains were jammed up, not just because we were borrowing. So yes, more debt can lead to inflation. But it's not the full story. The real risk is if the government keeps borrowing without growing the economy. That's when inflation could get out of control. Is this debt unmanageable? Warren Buffett doesn't seem to think so. He says that as long as interest rates stay low, it's manageable. But here's the catch. What happens if interest rates rise? Let's do some quick math. Right now, the US pays about $892 billion a year in interest payments, about 3.1% of GDP. If interest rates were to rise by just 1%, that would increase the US's interest payments by an additional $630 billion per year. And here's a shocking stat. The interest on the US national debt alone is expected to hit $1 trillion per year by 2029. That's more than we spend on the entire defense budget. And unlike other types of spending, interest payments are non-negotiable. If you don't pay them, you default. It's like having a credit card balance where you're only paying the minimum interest, but the principal keeps growing. Eventually, it's going to catch up to us. So, while today's debt might seem okay, higher interest rates might turn it into a disaster. Are we just kicking the can down the road for our kids? A lot of people, like Graham Stephan, think so. He says that today's debt means higher taxes for the next generation. But here's a twist. Some experts say that future generations could actually benefit if we use today's debt to invest in long-term growth. Think about it. If we spend on infrastructure, green energy, and education now, that could make the economy stronger for future generations. But of course, this is a gamble. Will the money actually be spent on investments or just more short-term fixes? So, is the US drowning in debt? Not exactly. It's more like the US is treading water in an ocean of debt, and the US got a pretty good life jacket, for now. But if interest rates rise, or if we stop growing the economy, that life jacket might deflate. The key takeaway is this. Debt isn't necessarily bad, but it's how we manage it that counts. As long as we're investing in growth and keeping interest rates low, we're not in immediate danger. But we can't take our eyes off the clock. But here's the big question. Can the US actually keep borrowing without hitting a breaking point? What happens if interest rates rise even further? For that, make sure you stay tuned to our channel because we'll be diving deeper into it. Before you drown in even more financial jargon, make sure to smash that subscribe button to keep your financial knowledge afloat. Every click helps keep me from drowning in, you guessed it, algorithm debt.